Good morning, everybody. It's Greg Schnell, and I am here with Arthur Hill to bring the December market outlook to you today. We've got lots to cover off. We've got our special guest, Arthur, in the house. And what we're hoping to cover off is the big picture. So, not so much trades for Monday morning, but setting you up for December and maybe even into 2018. So, we've got lots to cover off. Arthur's agenda has the broad market trend and strength. He's going to go through some semiconductors. He's going to talk specifically about some of the semiconductor stocks and the biotechs. He's going to get into the big biotechs and then how to deal with daily messy charts. And he's used two commodities as an example. And as we all know, those charts have been messy for a while. So we've got lots to cover off. I'm going to jump into looking for long reversals and talk about some of the new breakouts that are starting to happen. And it's not so much the dogs of the Dow strategy, but it's a bit of, things that have been out of favor for a long period of time, but are starting to change trend, make new 52-week highs or new 6-month highs might be interesting. And then why I don't wait for 52-week highs on commodities. So that's our rough agenda for today. At the end, we're going to have a question period. We'd love for you to put questions in the question panel on the chat box on the side there. So feel free to do that. And then with that, I'm going to hand it over to Arthur and allow him to take the screen from me, and he'll be able to start on his presentation again, going through broad market trend and breadth.
All right. Thanks very much, Greg. Do we have a handoff?
Yes, we do.
Okay. I guess everybody can see the first slide here that basically talks about what I'm going to talk about. I'm going to start with the broad market trend and breadth, because breadth is confirming the new highs that we've seen in the market. And this basically confirms that we're in a bull market, and we've pretty much been in a bull market since March, April 2016. And then we're going to look at a group that has pulled back, the semiconductor ETFs. And this is interesting because they've become oversold. And the question is, has the trend reversed? And if it hasn't, the question is this more of an opportunity than a threat? Then we'll look at 5 semiconductor stocks. We're kind of going to do the same with biotechs, because the biotech ETFs are bouncing off their November lows. Similar situation, oversold within an uptrend. And then I'm going to talk about the metals and mining SPDR and the steel ETF, because those daily charts have just given me a headache over the last few weeks and months. And I'm going to show you how I deal with those headaches other than taking a Tylenol or an ibuprofen. So let's look at the first group of charts. We're going to start off with candlesticks. All right, we've got weekly candlestick charts going back 2 years. And at the top is SPY, which basically represents the S&P 500. And that is my main market ETF or index. If the S&P 500 is an uptrend, then I think we're in a bull market. I don't need to look at small caps. I don't need to look at technology. If the S&P 500 is in a long-term uptrend, then I think that's enough to say we're in a bull market. And we can see that we've had this golden cross back here in March for SPY when the 10-week EMA, which is equivalent to the 50-day EMA, crossed above the 40-week EMA, which is equivalent, not exact, to the 200-day EMA. So we've just been in a very nice uptrend. And you can see you have consolidations, you have corrections. I had another triangle consolidation in February, March 2017 here. You even had, look at that, 5 weeks of nothing. All right. And pretty much 2.5 months of nothing. And then we took off again in August, had a little bit of a sideways price action in October into early November, and then a move to new highs. So this is a clear long-term uptrend. How long it will last, how far it will go, I have no idea. All I know is I can identify the trend and trade accordingly. And that means looking for bullish setups. So as far as an area to watch, you can see that 10-week EMA coming in around 255, 260. And then we have kind of a little consolidation zone. So, a pull back to here might be the next opportunity to partake in this long-term uptrend. Now, looking at QQQ, we can see a similar long-term uptrend, 52-week highs in late November. So nothing really wrong there. Had a couple of stalls the past 2 weeks, but no real selling pressure. There hasn't been a rotation out of large cap tech stocks. All right, they've maybe traded a little bit flat, but there's clearly no decline of significance here. I mean, the last significant decline was July, August, had another one in June, and there's really been no decline here to speak of. So we're still in an uptrend and haven't even corrected. We look at small caps, IWM. This one, was underperforming through most of 2017 up until August, but that did not derail the bull market. They were just underperforming. Still an uptrend there. Choppy, slow grind higher. And now we started accelerating and this little channel breakout. And you can see hit a new high this week. So now is breadth confirming these new highs? And I'm getting a little. So I've got some breadth charts. And the great thing is you can recreate these breadth charts and you can create them for a number of major indexes and the sector SPDRs. And these breadth charts are made up of 3 breadth indicators. And what I've done is, close that for you. I put the 50-day EMA and the 200-day EMA on SPY here in the top window. I've got the AD line with the same EMAs in the second window. Lower down, I've got the AD volume line with the same EMAs. And below that, I've got the high-low line with the 20-day EMA. And the reason that has a shorter EMA is because the high-low line is a lot smoother than the AD line and the AD volume line. Now, you can see these indicators down below. If you look at this chart here, and in the Arch Charts commentary on Friday, I've got a chart, this chart here. But there's the symbol, the S&P 500 ADP, which is advanced decline percent. And that is advances less declines divided by total issues. So it's the net advances, if you will. And you use a cumulative measure of that, and you get the AD line. And I did it twice because I wanted to put the 2 moving averages. You can see there, 200 : red because I wanted it red, 50 : green because I wanted it green. And then I did the same thing for UDP. SPX UDP is up-down volume percent. That's the AD volume line. And then high-low percent is HLP. Now, each of these symbols, you can see SPX is the index symbol, and then ADP is the breadth symbol. Well, you can change that symbol out if you want to get that for small caps or mid caps, or if you want to get it for the sector SPDRs. And how do you find those symbols? Well, I'm going to go over to the free charting page, and you can do a search. And you can search for advance and decline and percent. And by using the term and in between, you're requiring all 3 of those terms to be in your search results. So I think I hit search, and I think it's refreshing. I'll just do an enter to get that going. There we go. And so we get our search results, and we've got everything now. Articles, documentations, and I'm going to click the symbols link, and that'll show me all the symbols associated with those 3 terms. And there you can see Dow Transports, advanced decline percent. So I could create an AD line for the Dow Transports, as well as the advanced decline volume line and the high-low line. So if you want to create other symbols using this, that's how you do it. So let's go back and look at these charts. So breadth is confirming the bull market because there you can see this AD line hitting a new high this week, and the AD volume line as well. And you can see that the 50-day EMA of the AD line has been above the 200-day EMA since March 2016. Same for the AD volume line. Actually, that's April 2016. And then we look at the high-low line. Look at that nice, steady rise. Haven't had any significant new lows in a long time. And this is within the S&P 500. Keep in mind that these breadth indicators are specific to the S&P 500. You can't really look at a chart of the S&P 500 or SPY and use breadth indicators for the New York Stock Exchange, because I think about a third of the stocks in the S&P 500 come from the NASDAQ. So you wouldn't be playing with a full deck, so to speak, there. But, new highs all around. So the bull market is clearly confirmed, and that's the way we need to be trading, is on the long side. Now, I also did these indicators for the S&P 400 mid-cap index. And you can see there's a symbol over there on the left, $MID ADP for the advanced decline line. And you can see over on the right a new high in late November. We didn't get a new high this week, but a 2-week small non-confirmation. I'm not going to read too much into that. The AD volume line also hit a new high there. Sorry, that's the AD line again. There's the AD volume line, one lower. And you can see you got a little signal here from the high-low line. In August, it dipped below its 20-day EMA and then turned back up at the beginning of September. And that's been a nice run we've had from the middle of August to now in mid-caps. So now the next one would be small caps. And to create those symbols, those AD lines, you can see I've got on the left-hand side, $SML ADP for the small cap advanced decline line. And then on the left-hand side, $SML UDP for the small cap advanced decline volume line. And then there's the high-low line. And there's that dip in August and the upturn in September. So basically everything is confirming we're in a bull market. Now, does that mean we're not going to get a correction? No, we still could get a correction, but it means we probably want to be looking to buy the dip rather than get negative on the dip or consider it a threat. A dip's going to be more of an opportunity than a threat. And so speaking of that, we've got the semiconductors. And that's kind of basically my rule of thumb for trading is I'm looking to find short-term oversold conditions within a longer-term uptrend. And you look at the semiconductor ETF SOX, that's a new 52-week high in November. This is a sharp decline, but we're right at this 38% retracement. So we had the big move from July, it started earlier, all the way up to November, and now we pull back. Now, could we go, further down towards this 50 to 62% retracement zone? Yeah, we could. I mean, anything is possible. All right. But right now we're at the first oversold reading because you can see 10-period RSI dip below 30 there. So we've got a potential mean reversion set up. And if I say what stocks or what ETFs have the potential to hit new 52-week highs later in December and January, this one would be at the top of my list as a potential to hit a 52-week high in the not so distant future. And then here's the semiconductor SPDR. And you can see a similar setup here with the pullback. It kind of got a broken resistance zone turning into a support zone, classic TA. And right at that 50% retracement mark, RSI at the bottom did not get below 30, but it got close enough to oversold. So this is a group I've got my eye on here. Now, looking at some of the top stocks, the ones that I was noticing would be Intel and then 4 of the semiconductor equipment stocks. All right, so Intel, of course, is the big one, and heck of a run here with this big gap. And now it's corrected because it was very overbought here after this surge. And now it's alleviated those overbought conditions and come down and you got these three small candlesticks to consolidate. That's indecision. And if we can get a pop and a breakout there, that's going to open the door to more new highs from Intel. Now, the next one is applied materials, and you can see a resistance zone around 48 turning into potential support. We had that long black candle and then the spinning top and misspelled candle there. Sorry about that. And now we're getting a bounce. Now, we didn't have a good day on Friday, but we got a bit of a reversal working here to watch. This is KLA 10 core, the next one. And this looks like a big cup and a handle is taking shape. And if we get a flag breakout, then that would argue for a break above rim resistance and a confirmation of that cup with handle pattern. And then we got Lam Research, again, broken resistance turning into support and trying to get a little reversal working here. And then the final one, Teradyne, firming up here and trying to get an upturn. So the other group I'm looking at would be biotechs because they have a similar setup going here. All right. And got a really good move on Friday in biotechs. And this, the semiconductors and the biotechs were mentioned in the Arch Charts commentary on Thursday. So here we can see 52-week high. So when you've got a 52-week high within a couple of months, that tells me we're in a long-term uptrend. All right. If we're in a long-term uptrend, it tells me I want to be trading with a bullish bias. In other words, I pretty much want to ignore bearish setups and look for bullish opportunities. All right. That would be pullbacks within the uptrend, oversold conditions. And you can see we became oversold here in late October, but continued down. So yeah, sometimes that happens. You stay oversold. All right. But we bounced off this August low. It looked like we were going to get a breakout here in late November, but fell back, but held support. And now look at that surge. So this is looking promising. And if I'd say which ETFs have a chance of making a new high later on this month or in early January or in January, this one would be at the top of my list, IBB. All right. I don't want to be talking about it when it's breaking out at 114. I want to be talking about it now. All right, the next one is the biotech SPDR. And this one is a bit stronger than IBB because you can see here's this August low, and this pullback did not get to the August low. It held above it. And if you look at the components, the IBB is dominated by the large cap biotechs. All right, I'll just go right back to that chart. I should have pointed that out, but I can go back fairly easily. So I've got the holdings here. The top 10 holdings account for 55%. All right. You say, well, where do you find the holdings for these ETFs? Well, you just got to Google that. I was looking for the holdings in the steel ETF, but here, if I search for biotech, IBB holdings, sorry about that loud keyboard. And you want to go to the site of the ETF family like iShares. You don't want to go to Morningstar or ETF.com. Go to the actual site to get the most up-to-date information. And there you can click on the portfolio link on the top right there. And you can see all the top holdings. And this will tell you what's driving it, and it'll tell you what type of an ETF is it. So this one is clearly dominated by large cap biotechs, the biggies. All right. Whereas you look at the XBI and you look at the top holdings, you can see that the top 10 holdings account for just 24.7%. And you don't see any of the big boys there. There's no Amgen, there's no Celgene. All right. No Biogen, IDEC. All right. This is a more evenly weighted biotech ETF. It's more representative of the group as a whole, XBI here. So we have this kind of channel flag correction after the 52-week high, and it looks like we're turning up and breaking out again. So biotechs are looking pretty good here. So I've also got a chart with the top 5 holdings of IBB, because if you want to see a breakout in IBB or sustainable move, you're going to need to see these top stocks moving higher. And here's Biogen, and you got that little flag pattern and a breakout happening. So that's looking positive. Here's Amgen, held the August lows here and turned up, fell back a little bit this week, but still looking more positive than negative. That's the 50-day EMA there. Gilead. Now, this is an interesting one. I think Tom Bowley's highlighted this one a couple times, because there it is at support, and it's tried to bounce but fell back, and it's trying again. So if you get that second move above that early December high, Gilead could be on its way to another new high. Now, these three are clearly the leaders, all right, because they held their August lows. So you can see these three. Look at these August lows. Biogen didn't even test it, whereas Amgen and Gilead did. And then if you look at Celgene and Regeneron, they just plowed right through their August lows. And actually, Regeneron broke its August lows in September. So these are showing some relative weakness, but look at Celgene. All right. It pretty much bottomed after that second gap and is starting to turn up. So it's one to watch going forward. All right, so our next group, we're going to go to metals and mining and steel. And what happened here was, I've got this daily chart, and I'm looking at this daily chart and I'm going, man, this thing has gone nowhere for pretty much a year. You have a decline below the 200-day and a move back above, and then what looks like a support break here. And, oh, no, it didn't hold, and you move back up. And I'm like throwing my hands up. You know, I can't figure out this chart. And when that happens, I pretty much just go to a weekly chart to, you know, take a step back and try to get some perspective. All right. And even if you have a longer term outlook, you can use those weekly charts and kind of focus in on the last few weeks, and that'll give you a better idea. And so I've got to go to a different chart list to see that weekly chart. But that is no problem. This is the Arch Charts chart list. It's updated every week, and you can see it with the 30 industry group ETFs that I follow. But looking at this weekly chart here for XME, let me scroll down just a little bit there. All right. So this is a 2-year weekly chart, and look at this monster move. And after such a move, you would expect some sort of rest. And so we got the pullback here in the wedge. And then we kind of flatlined a little bit and then got a little wedge breakout. And I would say that this trend since May is up. It's not the strongest trend I've ever seen. And then we kind of got a 3 to 4 week pullback here in October into November, and then that 3-week breakout. So this one is looking positive, I think, and it could be ready to challenge that February high. It could be one of the next ones to hit a 52-week high. And at the bottom, I've got the PPO 5200 zero. And why did I use zero? Well, when you use zero, you don't see a signal line. And the PPO is a difference between two EMAs. It's a difference between the 50-day EMA and the 200-day EMA. And so when I show it as in this way, it's a histogram. And when it's positive, I know the 50-day EMA is above the 200-day EMA. So that tells me there's still a long-term uptrend here. Even though it's clearly slowed, it's still an uptrend. And we got a recent breakout. And the other interesting one is steel. And the reason this one's interesting is because it was up almost 200% from the January 2016 low to this 2017 high in January, February. And then looks like potential cup with handle. Now, it's not confirmed until you break out to a new 52-week high. But as I said, I want to be interested before that 52-week high. Not that a 52-week high is bad, but here we got to pull back, and it looks like we've broken out here. So if we get up to here, the cup with handle would be there, complete, but not confirmed. And if we break out at 46, it would be confirmed. So here's what's interesting. Steel was the leader in 2016. It was the laggard in 2017. So maybe it's going to return to the leaderboard in 2018. All right. So that finishes my portion of it. And I'll switch back over, or Greg will grab the screen here and give his portion.
Okay, thanks, Art. Appreciate that. And he did a great job of a transition from the biotechs into the commodity. So one of the things, I write the commodities countdown blog, and so Arthur and Tom do a great job of covering off the biotech. So I cover them off like very little, and try to focus my energy on something totally different. So you'll find a lot of my stuff refers to commodities, refers to the Canadian market, but I will talk specifically about a lot of things going on in the U.S. market. And so for more Canadian content, you can go to the Canadian Technician blog. But for the US stuff, I usually cover US stuff off on the Commodities Countdown blog. So if you're interested in commodities, and Art just did a great setup there with steel, suggesting it might be ready for a big breakout. I'm going to talk specifically to that. And one of the things that I'm starting to notice is there's a conversation called the dogs of the Dow, and basically you sell the Dow winners and you buy the Dow losers, and that's under the understanding that the management teams are really big and strong, and they don't let things slide very long. So you try to buy the dips. I'm not so much interested in that, but at the end of the year, you've got management teams around the world sitting around saying, what are we going to put our money into next year? And perhaps we should start to get set up for 2018. And when they do that, they're looking for different things. So things that have run forever, not a bad time to start taking some money off the table and maybe look for some opportunities. So that's what I'm going to cover off. I'm going to go through some of the new breakouts that are happening. Valiant, Shake Shack, that kind of thing. But I'm also going to talk specifically into the oil sector, and then and I'm going to talk about some of the oversold levels that we're seeing in silver, gold, nat gas, and why I don't wait for the 52-week highs. And so hopefully with all of that, we'll probably run out of time long before I get the chance to finish. But let me just grab this here. Okay, somehow I did that wrong. Okay, continue. There we go. That's what I want to get to. Okay, so this is Melee, and Melee is a Brazilian supermarket, but you can see that it basically followed the big run up in commodities, and now it's based and gone sideways for a while, just consolidating. And with that consolidation, I think the most important thing is, you're watching it build. You don't need to wait for this to break to new 52-week highs, like Arthur said. If you're starting to get some signals that you like, maybe it's your PPO starts to turn up. This is a weekly chart, where the scooter ranking starts to improve again. Whatever you find some ideas. But the point is that some of these are really getting set up nicely. And so while they aren't on everybody's radar right now, these were significant runs where it was a top performing stock for 6 or 8 months, and these things are running. And one of the other things that brings them into focus was when Brazil came into focus with the commodities rally. A lot of the stocks from the same country started to run. So even if you're not a commodity trader, you might want to use that leverage to get back into commodities. So anyway, I point that one out as an example. Valiant is a very hated stock after a huge dive. So 260 all the way down to $8. And if you were in it, you probably never want to talk about it again. But the important thing that I'm just going to draw a horizontal line here right around $20. And what you could see on this Valiant is whatever, let's just pick 1950. So it's a little different. And we're going to pick solid, and we're going to pick red. And with that, what you see on this chart, what didn't I do? Somehow I got to Halliburton. I don't know what happened there. Okay, let me go back. My mistake. That's really weird. Must have changed the box or something. Okay, so there's Halliburton. And or sorry, there's Valiant. And what we see here is this huge base has been built, and we could even move the line down to call it $18 or something just to reflect those previous highs. But we're starting to break out to a new 52-week high this week. And so after, this was really a year and a half of bloodletting, and then all of a sudden it really based for the last year. And you could see, this most recent test jumped up, and there's a great blog that's done on stock charts by Bruce Fraser, and he talks about um, building bases, and it's the Wyckoff method. And one of the things that, in a Wyckoff method, they talk about the spring, the final kind of test to the lows, and then you break out. I wrote about this one in the Don't Ignore Your Chart yesterday, but the important thing here is everything is starting to come into sync. The 10-week is above the 40-week. You're breaking out to new highs. Your full stochastics is saying that it's in the top 10% of its previous trading range. Obviously, it's right near the top. And then the scooter has just gone positive. I really like that. And here's your MACD or your PPO just starting to turn positive. Volume expanded on the breakout. So there's a whole bunch of things going on here, and so there's a lot of attention being given to the stocks that were continuing to work. But this is also a good time of year to watch for things that have been basing for 2017 and started to break out to 2018. Another example of that type of trade is Shake Shack. And the point I want to make on Shake Shack, this one was in Don't Ignore Your Chart roughly a week ago, and we can just draw a line right in around $39. And what you see here is, a nice clean breakout out of a 2-year base. So this stock was, opened at $20. Within a couple of months, it was up around 100. I think at this point there was some certain television analysts talking about the stock could go to 3,000, and it's just a great burger chain and blah blah blah. And anyway, needless to say, it didn't go that way. But the lows were sitting in here all around $30, a little higher, $31. But we ended up with our final test of the lows. It spent 6 weeks down here and just ground down. Volume got a little quiet, and then all of a sudden the stock has rocketed up. And this sort of base, we're starting to see it in multiple stocks. And I started off the show with the Miele, Miele Labra, or whatever, the Mercado Libre. And you can see this sideways consolidation. And my perspective on these is this is a great time of year to try and find those consolidations and see which ones are breaking out. So on stock charts, we have a scan that's all set up that looks for new 52-week highs. And the way you would find that, you would just go to your members tab, and down here we have scan workbenches and all that kind of stuff. And then here we have predefined scans. And if you go into the predefined scans, here's new 52-week highs. Now, one of the things that's nice is it lists basically everything that's breaking out to a new high. But part of the problem is it doesn't say that it wasn't at a new high 2 or 3 days ago or whatever. So I've got a little scan here that I've written, and it's pretty simple. Region is North America if you want both Canada or the US. If you don't want that, you would just comment that out and just say country is US only. And so country is US. We want to look for stocks. We want to look for whatever volume level you'd like. Today's high, so this is straight out of the predefined scans. Today high is greater than yesterday's daily max. And you could go down here and pull that up from here and just say the new 52-week high scan. And if you added it, it would give you this line. So if you want to find something that's broken out relatively recent, you could either use a 1 day ago close is less than 3 days ago, or you could get rid of these 2 comment bars here at the front and just go like that and select this line instead. But the idea being you're just looking for something that wasn't at a new high a week or 2 ago, and Miele would start to show up in there, Valiant would start to show up in there. All of these different little scans will help you find that. And then you can go back and look over a period of time. So you could do this for 5 days ago or whatever and run these. Now, again, this isn't a scanning exercise, but the whole idea is just try to show me some of these stocks that are breaking out. And so recently, so I ran this scan, and of course, Valiant came out Martin Ray International is a Canadian stock. Here's Valero Energy. So, it's trying to find stuff. It's not going to get it perfect every time because 3 days ago the um, price closed different than one day ago or whatever. But the issue you've got is you're not always going to get it clean, but what you're trying to find are these breakouts from big bases. And I think this is a great time of year to look for that. It's always a good time to look for breakouts from clean bases to try and get going. So in general, I'm really starting to lean towards that side. So now I'm going to give you some examples in the oil patch, and then we're going to go into the metals and miners like Arthur covered off, and I'll give you some other ideas around that. So this was an article going back to September 14th, 2016, and we don't even need to go deep into the article. But Apache announced a new discovery last week. It expected to find more than 15 billion barrels of oil and gas under its 350,000 acres. Now, the Permian Basin is close to it's in Texas. It's close to the U.S. Gulf Coast, so they can export crude, they can process crude, everything's there. They don't need a whole bunch of stuff. But this uh, find was the largest find in the last 20 years onshore. It was absolutely huge. And while the price of oil was falling, they were buying all of the land on the cheap while everybody was coughing it up. And so you would think that this stock has run crazy. Well, it's done exactly the opposite. So the find was announced in here, and the stock has been drifting down. Um, and the reason I brought up Bruce Fraser earlier is this is a great example of a base being built in a stock. And what happens is the large institutional holders basically will buy the stock, run it up a little bit, sell it a little bit, and they're trying to keep it in a range so that they can get large positions. And when you see these kind of sideways weeks where everything else is rallying since August lows and this great stock can't get out of its way, this is a lot of accumulation going on. And so well, it might not be your choice of a buy today. You can see that the 2016 lows when oil was at $25 is only a couple of bucks below here. Well, it's about $10 below here, so 25% off. But this is definitely trying to build a base in here. And so uh, I'm watching for a stock like this to either give me a huge sell-off low again, like another high volume selling place that I can start to look at to pick it up, or if I'm too late and it starts to break out, I want to get that trade, much like the Valiants or the Shake Shacks as they start to break out of their bases. But the underlying of this company is very, very solid. And so right now, the investors or the institutional investors are just continually taking it away from people who will sell them the shares, and the volume, under the moving average for most of the last 4 months, and that's because other stocks have been running and this stock's just stalling. But I continue to watch great stocks like this that are setting up. I mean, 15 billion barrels of oil, you can get by on that kind of thing. So you've got an uptrend in the lows, you've got a slight downtrend here, you've got this pennant pattern building, and uh, I would really be excited if this started to turn higher. It might not be for everybody, but for me, it's the kind of trade, exactly the kind of trade that I want to trade on. And I should have done this a little earlier. There we go. Stretches my screen a bit. So the one thing that I would say here is, as these stocks are basing, don't give up on them, but be aware of the possible trend change. But this has underlying fundamentals without getting into a whole bunch of charts. We just did a Google search. That's the only line we need. Largest find in the last 20 years, 15 billion barrels of oil, and they're spending roughly 600 million a year to start getting that going. Um, on there, you could go to their slide presentation or whatever, and they'll show you that the area of land they have and how everybody else has started to drill right around the borders of everything they haven't locked up. So they attracted the attention of everybody in the industry towards the drill bit, but they haven't attracted the attention of the investor yet. And so I really like long setups like this. You don't need to jump on it yet. If you can pick it up at 45 and it's going to go back to whatever 100 or 200, these are great companies, and so just don't let them get away from you when we get the opportunity to start buying it and grab them. Now here's Schlumberger, and they're a huge oil field service company. They provide a lot of technology. Look at how this stock is just trying to base right around the 2016 lows. They've been buying stuff under the radar while everything is quiet here. And again, I think oil's in a new long-term bull market. It might need to pull back for January or February or whatever, but I think the lows are well behind us, and we have lots of opportunity to the upside. So while these things are building bases, it's a pretty nice place to look. And again, shooting against this $60 or 62.50 level, you got lots of support in here over the last 4 months. I realize it's not an uptrend, but commodities are like that. They go from huge extremes, like, when oil was $25, you wanted to buy commodities, not sell them. And when oil's going to pull back to $50 here or whatever, you want to be looking hard at these oil companies if they start to move to the upside. Here's Halliburton. So I'm just going to do three, but I could spend days on these. And if you listen to Commodities Countdown, I kind of throw out a few every week. But this is the $45 level again on this stock. Really nice, basing pattern starting to build here. Moving averages are coming together. This looks exactly like that Valiant base where it's kind of working its way, higher lows, moving averages coming together, and then it finally starts to turn higher. Look at the volume in the last 2 weeks, above average. Um, the MACD momentum is heading higher. The scooter ranking is still low, but I like it when it starts to perk up. This tells me there's starting to be some interest. It might take off to the upside. In general, I'm very bullish on energy. Right now in the commodity space, the only 3 out of the 4, so natural gas is not, it's below its 40-week average, but oil is above, gasoline and diesel fuel are above. And the inventories have come much more into line. And the second component of that is since 2014, they've passed a law now that the US can export raw crude, where they could only export finished gasoline or diesel fuel previously to that. So don't use these old trend lines from a position where the US couldn't export crude to now determine your crude future view. There's a big change there. So that is another area that I really like. I think it's setting up great for 2017. Some stocks in the area that are doing good. I'm just going to pull up Suncor. This stock's been making new highs. So this is when crude was $100. This is when crude's $50 or $60. And these have been in nice uptrends. We were waiting for the July low. We got it. It was a beautiful run. And I think a lot of people had followed that run up. But Canadian Natural Resources bought all of Shell's assets. And I mean, I think it wasn't a sale. It was a stole. They absolutely bought 30 billion or $35 billion in assets for 8 billion. It was unbelievable. Anyway, this stock is just starting to break out to new 3-year highs. Let it pull back, whatever. They have 1 million barrels a day of oil in place. They bought, hundreds of thousands of barrels on very, very low prices. So there's some really nice setups. And ConocoPhillips, just to grab another one here, just starting to break out to new 2-year highs. These are uptrends that are in, but they're long and they're patient. So if you're not a swing trader, if you just want to kind of find some stuff to buy and hold, I don't usually say commodities are a buy and hold because they do this. But the one thing I would say is you're getting all of these stocks are really starting to set up for 2018. And I think it's a great time to look at them. I want to go into nat gas just briefly. And the point I want to make on nat gas is that, look at the volume expansion that we've got right here. And on other previous major lows, we get these nice expansion volumes. It's not a guarantee. This was that 2014 debacle when oil let go from 100 to 25. So this is a hard place to analyze. But I will say that when you start to get these huge oversold levels, and this is UNG, it's not the same as natural gas. I'll show you the chart in the middle. It's supposed to track, but they don't track that well. But you can see it's clearly breaking to new lows. So there's big volume coming in. And it's a great place to now start to look for a good reversal. Whoops. So these reversals are the kind of thing that in commodities you can play, and not so much in some other stocks. They don't necessarily have a floor, but when we start to see commodities get way offside, it's a great place to look. So this is the actual real chart of natural gas, not like UNG, which is a tracking ETF. Sometimes this doesn't work when I have my large arrow on here, so we'll just see. But the bottom line that we're sitting in here is, this is a pretty tight support area and it's just breaking down now. So while most people would be running away, for me, this is a place I don't have to buy it yet, but I definitely want to be aware that there's new lows coming. And most of the speculators have left the trade, and now what we're looking for is a big sharp reversal. So you don't have to take these trades, but I just think it's a better place to look. Um, sorry, better place to look for that kind of setup. Gold, let's talk about that because gold broke through support this week. And what you see here is that there was an uptrend. This is a 4-month low, but we were making a series of higher lows, and now this is coming into question. But you'll also notice that we have nice reversals in December uh, that were really good trades for 10, 20, 25%. And I don't usually trade gold. I usually trade the gold miner. So as an example, this move here for oil or for gold was 30%. The move in the miners during that same move was 150% in 6 months. So just while you hate gold because it's making new lows, it's probably one of the best places to start to look for a reversal. And as it comes down and tests this 1200 support level, like one of the things I noticed this week was Barrick Gold. Instead of making new lows while gold broke down, Barrick Gold did not. It made a new 52-week low and then closed the week near the high of the week. So, not the same candles at all. And so we're starting to see this big consolidation here. Most people would be running away from the stock. I'm still not buying it, but my point would be, when commodities start to make new 52-week lows, they're usually a better place. Like this was a 9-month low, and all of a sudden, bang, here we are making a new whatever 18-month low. Just be very cognizant that when it gets oversold like this, these can be excellent opportunities to step on the gas pedal the other way. And especially with the Commitment of Traders report out of Chicago, it can really help us identify oversold levels. So on my Twitter feed just the other day, you don't even have to be a watcher or read the charts from Commitment of Traders. There's plenty of comment around it. But here's the SLV is the ETF, and what you see on silver is it's trying to break through this horizontal support and resistance. So if support fails here, do you want to get long silver? This chart looks relatively ugly. Fully agree. The major point that we have is right now the net speculators are down to less than 10% of the contracts. And so usually when that happens, we end up with a big reversal in silver, and we could look for a move to the upside. So all of those things are set up. And again, these big runs off the December lows for the last couple of years give us a reason to look there. My last point, and I've said this over and over and over, is the US dollar. And the big thing that I'm looking for here with the US dollar, I'm just going to add the relative strength index on here. What we see on the US dollar, this is the work done by Connie Brown, is that over a period of time, I'm just going to add 15 years or something. What you see is over a period of time, the US dollar will go in a big bear market and it'll have trouble getting above the 60 level. And then it'll go in a big bull market and it'll have trouble getting below the 40 level. So we've been 6 years where we've been above the 40 level. And this year we recently spent almost 3 months below 30 on the RSI. Well, in a bull market, that doesn't usually happen, that something spends 3 months with an RSI down below this 30 level on a weekly chart. So what I'm actually been mapping out for pretty much since July and August, when we started to see some deviation in the US dollar, was that this would probably top out up in the 50 to 60 level. But we're expecting a final rollover, much like we got way back here in 2002. Let me just extend the chart a little bit more. The point would be that in this period here of a huge bull market, the dollar was running up. We had one brief dip down here on the Asian financial crisis, spent about a week or two below the 30 level, but for the most part, it was 6 years of above 40. And when that finally broke, that was a great place to be aware of a major trend change. And the US dollar went on a bear market for multiple years. While that was in a bear market, commodity stocks went the other way. So um, uh, Vale, Rio, Freeport McMoran, BHP, and Tech Resources all were stunning stocks to own. So just if you see this kind of big downtrend when the U.S. dollar was letting go, this is the top of the construction here. We're pretty much with that same sort of top now. We've had the break in there. We've pulled back down to kind of the bottom of the range. We consolidated for a period of time, and towards the end of the year, that really started to let go. Whether it happens in December or January, that's kind of what I'm looking for. I'm looking for a big change in the US dollar to really start breaking down. And if the US dollar starts to break down, I would expect the next wave of global expansion to take off. And all of these stocks like Rio, I don't want to be on a 25-year chart here, but let me just go to a 3-year weekly, so that'll catch the 2016 lows. These charts have come up, and like Arthur said, they're just basing sideways for 6 months here. If the US dollar is going to break down, all of these stocks, because remember the US dollar topped here, um, all of these stocks went on big runs for now. And if we look at BHP, so just look at the group of them and see if you agree. But all of these are just setting up here as a sideways consolidation after big runs and have the potential to do it again. Now, here's Tech Resources. This is a huge copper producer, coal, metallurgical coal for melting steel. Cobalt. They're in lots of the rare earths, zinc, that kind of stuff. So all of these things that we need for electrification of cars, they're there. Look at this big 1-year base building here. So this is really a nice area to look. And if you look at Vale out of Brazil, this stock has soared sideways consolidation for a year. Here's that cup with handle that Arthur saw on the steel charts, all setting up here, getting ready to rock. Here's Freeport McMoran. Remember, the metals had an absolutely terrible week this week. Copper was down hard. Freeport McMoran ignored that. Gold was down hard. Freeport McMoran ignored that. So I think these are some really exciting places to be aware of. And again, while we see gold so weak, and just to show you the chart for copper for the week, it was crushed. Big down candle, breaking a couple months of support. Freeport McMoran going the other way. The big picture on an electric vehicle car is it takes 200 pounds of copper compared to 50 pounds of copper currently in a car. So you're to do that, it's stunning how much copper we would need if all of the cars start to come out with um, as an electric vehicle. Second component of that is then we need to electrify the grid. So there's a great article in a website called driving.ca, and he covers off the inconvenient truth about moving to alternative fuels or to electrification of cars. And the big point he makes is, on a main highway route where you have 16 or 32 gas pumps at a gas station today, those gas pumps would need 960 electric vehicle chargers on one site just to keep up with demand. And then while you're there, you still got to wait, 15 minutes, a half an hour. Currently, they're 2 hours, and those machines are, they run a lot of money. If you got to the super fast chargers that take 15 million, they're like $1 million each. So that, obviously you don't need 900 of them, but let's just say you need 100 instead. So you're going to spend $100 million on one site to electrify the site and get it ready. That's just on location. Now you need to bring copper from the main transmission lines to all of these highway fueling points. It's a big deal to electrify the grid. And so, don't let people talk you out of big uptrends in copper. Try and find the good stocks and be ready to ride those. I think 2018, much like lithium, was a great year. This is only the beginning. And we could find, again, they might relax for a couple of months, whatever. The big picture is if this whole thing's going to go forward, you probably want to be on board. And, I wouldn't be buying lithium with all of this attention and the rollover here at the end. I'd probably give it a chance to relax, maybe down to the 40-week, and then start to look. So hopefully those are some, I'll call it, different ideas and reasons for different ideas. And again, just wait for your charts to set up and take the trades. But I think, looking across all of those major metal companies from around the world, two of them were Australian. FCX is out of Phoenix, Vale is out of Brazil, and Tech is out of Canada. That's a global look across those five charts. And when they all start to work together, I think you want to be a part of that trade.
Hey, Greg,
Yeah.
can you pull up the chart for XES, the Oil and Gas Equipment and Services SPDR? Since you're talking about Halliburton and Schlumberger, maybe you can comment on that chart too.
Yeah, like these charts are just starting to get set up. This was the base in 2016. And you'll remember a lot of the crude companies or the oil companies went up for a long time. These based for another 6 months and then started to roll. But look at this double test of the 2016 low. Like that was oil at 25. This was oil at 42. These are a great place to try and get on board rather than a place um, to to leave the party. So I'm really excited about this. The one chart I didn't pull up, and I really should have done that, was the 5 year on steel, or even the 10 year on SLX. And let me just go grab it. And there's a reason that I specifically want to point it out. That shows it for the most part, but it's the scale and context. Okay, if we're going on the next bull market, look at this $45 level. We can just add a horizontal line here, but all of these charts are setting up now. The biggest single industry that uses steel is the oil business. Everything we build has steel in it. So when we drill a well, we use steel pipe. When we haul a skid out to the site, it's steel. We use truck trailers that are steel. We use to complete the well, we use the pump jack systems. We use the compressor stations, all of the flaring stacks. Everything on that site is made out of steel, and it's resilient in different temperature climates, but it's being driven to the back roads of nowhere. So we need a lot of flat deck trucks, and we need new trucking equipment to haul it out there. The rigs get dragged around by heavy equipment haulers. The fracking trucks are huge now. They put big Caterpillar engines on the back of a truck, and they'll line up 5 or 6 of those in a row, and build up the pressure in the ground and crack the ground all at the same time. So there's so much steel that goes on in the oil business that if the oil business is going to start to turn out, you'll probably see it on this steel chart. And a breakout here is a really, really, really nice indication that all of these frackers and the oil field service companies are going to start to rock. Now, I could take Calfrac Well Services in Canada just as an example. So these companies were beaten down, given up for dead. This was $1. It's a $6 stock, so it's up 600% in 1 year. Just started to break out to new 52-week highs again. Above the 10-week, it's a really nice place to own it. Even if it pulls back a little bit, I would say don't take your eye off the ball here. There's a lot of opportunity. OPEC's agreed to limit production. We're seeing all of the inventory levels drop quite a bit. One of the other components is that the SPDR, or the Strategic Petroleum Reserve, the SPR, they're releasing oil out of that. And so that adds a little bit to inventory. But the bottom line is we're seeing the inventory levels worldwide come down more into line with demand. And so we should see the oil price firm up into I'm expecting at least the $80 level by April, but maybe I'm too bullish. So.
Well, I like the point you brought up on Freeport-McMoRan, because it's true. If copper had a really bad week and gold had a really bad week and Freeport-McMoRan went up, that's something that's unexpected. And when something goes the opposite direction than it should, or than you would expect, that tells you something is up. So that's pretty interesting, especially when you look at the 20-week correlation between Freeport-McMoRan and copper. It's very positive.
Yeah.
So yeah. And copper looks like I said, looks like it's a pullback within an uptrend.
I would fully agree. I mean, anybody who thinks copper isn't on a big uptrend, I would just say be careful, because there is so much opportunity with this electrification of the grid, and every car company wants to bring out an electric vehicle, and now they're trying to bring out electric SUVs. We've got, electric trucks, those big highway tractors. A big highway tractor refueling station needs the same amount of power as a 27,000 person city. So, when you're pulling up to recharge your tractor trailer, the grid connection required just to get that energy on site up to that level is huge. So, whether you use a photovoltaic panel or geothermal or something to create the energy, you still got to get the energy to a site, and to do that is a huge amount of copper, and we don't have that copper in the ground, that kind of volume per site. So there's a lot of work to go to electrify the grid.
Well, it looks like on that copper chart, somewhere around that 2.8, 2.9 area, you kind of have broken resistance turning into support, and you got a rising 40-week EMA. So, copper's coming into a potential support zone that it should be watched, I think.
Yeah, and if the U.S. dollar does what I expect it to do for 2018, I mean, that was kind of the big thing that happened right here. And in both 2000, just go quickly look at the U.S. dollar. Both 2016 and 2017 were meaningful turning points for the U.S. dollar. Here's 2015, dollar was running up, kind of topped out. Here it was the final high, rolled over, and then here it was the final high. Now we're consolidating. Back in 2002, it was kind of that way where it was about roughly 1 year later from the actual high. It went on to make a slightly higher high in this particular year and then come down and consolidate. But these consolidations, like way back 2002, it was roughly the change of the calendar within a couple of weeks that all of a sudden the big drop started to fall. It happened in early December in that year. But I just think there's some really good setups here for metals, and if you're looking for some really interesting areas of 2018, I think the U.S. dollar backdrop, those metals and mines, that steel chart just hovering right at that level, all suggest big price action. And when everybody gets bearish on gold and silver, you want to be looking to get in there, not get out there. And so I'm
one
today, but you have to watch.
Yeah. Greg's right about, you do have to watch the dollar, especially for that steel ETF, because if you look at the top holdings, they're all non-US. Yeah, US steel is in there. But when you look at the top holdings, it's going to be Vale and Rio and all of these non-US stocks. So the dollar is going to affect, because basically what happens is they're buying, it's the stock priced in the local shares and then converted into dollars to put into the ETF. So you do have a currency component there in that ETF.
Yeah, and the one thing about steel, I mean, there's a whole bunch of trade tariff issues with China and that kind of stuff. So, it's a real political football. Nobody wants their steel industry wiped out. So there's a lot of tariff stuff that goes on around there. That's very supportive for the price of steel or internationally. So it was against anti-dumping, where people would put cheap steel into America because they were trying to keep their production levels up and employment levels up. And so with the tariffs, it stops some of that. But anyway, I expect if the oil patch starts to rock, the steel chart's going to change, the copper chart's going to change, and all of these companies could have a tremendous 2018. I think the dollar's the key. So, okay, we are already at 1 hour, so that's that is fast. I didn't get a chance to look at the question board right at the end here, but hopefully we get the opportunity to cover off some of your questions over the next weeks in our blog. If you could post them there in the channel, we'll try and catch them with our blogs. Art, thanks for taking the time to join me. We put together quite a bit of stuff there. Hopefully there was some educational material for people, and thanks for spending time. It's late where Arthur is. He's over in Europe, so we'll let him get on with his Saturday night. And
glad to be with you guys. Greg, enjoyed it.
Okay, great. Thanks everybody. Bye-bye.
Bye-bye.